go ahead, I just want to read a disclaimer, which is a legal requirement. This training program is for educational purposes only. The provider advises that the services, products included but not limited to training and coaching materials are for educational and or illustration purposes only, and are provided with the understanding that the provider is not engaged in rendering legal, accounting, financial, or other professional opinions. The following content has been researched and published in good faith without warranty or liability for any erroneous, incomplete, or misleading information. Please note that investing involves risks. Any decision to invest is a personal decision that should be made after thorough research, including a personal risk and financial assessment and review with your own legal and financial experts. Results are based on each individual, the action they take, and the time and effort they put in. So this was just a requirement in terms of the legal disclaimer here. I will go into the key structure of this webinar. So as far as this webinar is concerned, I will be going through 2 spreadsheets. Before I get into those spreadsheets, I want to let you know a couple of things. I'm not sure how familiar everybody is with Excel. In Excel, you have worksheets, and then you have the actual spreadsheet file. The worksheets are 3 worksheets in this Excel file. One is the disclaimer that I read. The other one is the actual presentation itself. And the third one is formulas. So that third worksheet, you're not supposed to touch that third worksheet. This is not a worksheet that was designed by myself, first of all. Secondly, all the formulas that work in the background, they create all the analysis. So so you don't have to do anything with these formulas over here. You see that there's a lot of formulas there. Okay, I got somebody else to admit, so give me a second here. Okay, welcome, Jug. Okay, so we are just getting started. So I was just describing that there's I'm gonna go through a couple of spreadsheets in this webinar. These spreadsheets have worksheets, and those worksheets have, in the worksheets, there is a formula worksheet, which you're not supposed to touch. Also, do not be overwhelmed with the number of all the numbers over there. A lot of this worksheet is for advanced analysis. We will be focusing on key analysis, what an investor looks for when they invest, or if somebody owns a rental property, how would you know how the property is performing? So we need very few matrices that I will plug in these spreadsheets to generate the results that we are looking for. Okay, so with this, I want to get started with that. Also, the purpose of this webinar is not to go through assessment of the why to invest in real estate in terms of there's a full webinar that I did that goes through the power of real estate investments, and that goes through the risks and the benefits and the leverage that you could use. So this is focused on having a tool available where you could plug in few key numbers, and it generates some really useful information for you. So with this, I'm gonna go start the analysis on this spreadsheet. So if you look at it, this spreadsheet has many sections. All you need to do is to simply fill in each of the light blue colored fields. So you're not supposed to look into any other information over here. The information that you will plug in is in light blue colored fields. So I will plug in that information. What you need for that, what information you need is, I'm gonna open that up so everybody knows that what we are looking at. Okay. So if you see on my screen, this is all that we need to fill this worksheet. The property purchase price, we need an interest rate, amortization terms, We need to know the property taxes, utilities. Vacancy rate is in predefined, so you don't have to worry about that. Condo fee, if it's a condo, insurance, maintenance and repairs, and rent. So we will be playing with these fields only to generate what we want to gain out of this. So going back to the worksheet, this worksheet has a first column. You look at the first column and it talks about the acquisition and financing. Over here, there is the property purchase price. So again, we are analyzing a freehold, a detached or a semi-detached freehold property. And for the first spreadsheet, I will myself plug in numbers to demonstrate. And once that is finished, in the second spreadsheet, I will go into a condo analysis. And the numbers are pre-populated. You don't have to plug in those numbers again. Both spreadsheets generate same results in sense of the same structure. So this over here, I'm and to make it more realistic, these are actual properties, and I know the taxes and I know the utilities and things. It's more like real. It's not made up numbers. So the property purchase price is 545,000. So we put in the property purchase price here. The next thing that we will put in over here is the interest rate. So I'm going to go with the interest rate when this property was purchased, and then we can do some what if analysis to see how that impacts. So 2.69%. The term of 30 years is already pre-populated there. Again, anything in blue can be customized, can be changed according to your requirements. So this is all that we needed to fill over here. So I'm just gonna zoom in a little so you guys can see this spreadsheet better. And I will send the spreadsheets to all the participants once the webinar is over. So I put in the purchase price. It automatically has built in that the 20% is the down payment, 80% is the mortgage on the property. As you can see, some of the calculations over here are automatically done. So it'll populate the closing costs, which means that it's gonna give a closing cost of all the legal fee, the transfer tax. So it will populate that number. Again, these numbers are not totally accurate or to the T, but that it's a good parameter within which you can analyze. Also, when you buy any rental property, you cannot just on the day after purchasing that property, you cannot put it for rent. So we are assuming that the property is vacant for 2 months. There could be many reasons. The property may need some preparation required, some paint may be required, and other stuff to be done. You may need to put it on the market. It will take time to filter and find out the tenants. So it automatically reserves 2 months of expenses in your initial short-term financing or short-term capital. So it's pre-populated there, the 2 months of expense. And let me just minimize this and go to the next section. It becomes too small. Over here, I put in the interest rate and the 30 years term. It will populate the monthly payment that you would be paying. Now let's just plug in before really analyzing anything else. We need to plug in the expenses and the income or rent in this. So the taxes, the taxes for this property is $3,680. There is no property management involved here. There's no utilities because the utilities are paid by the tenant. So utilities is zero. It's pre-populated that the vacancy rate is 2%. Okay, I minimized it a lot. So let me just increase the size again. So over in this column, vacancy rate is 2%. Um, as this is not a as this is not a condo, there is no condo fee involved. The insurance for this property is $900. That's yearly. And then maintenance and repairs, I'm assuming $100 per month maintenance on the property. So now we will put the most important number over here, which is the rent for this property. So I'm gonna put in $2,000 for the rent, the current market rent for this property. Okay, so this is all that we needed to put in this spreadsheet, and that will give us all that we need in terms of analyzing whether it is worth putting in, worth investing in that property. If you are already if you're already the owner of this property, whether it is generating the right type of profit or results for you. So I want you to really focus on these columns over here. There are 5 columns over here, and these 5 columns are based on the fact that it is, if in the first 3 column, it's a 5-year horizon that we are looking at. In the last 2 columns, it is a 10-year horizon that we are looking at. Okay, and we are analyzing an annual appreciation of 0%, 5%, 7% for 5-year time span, and then for 10-year time span we are analyzing 0% and 5% appreciation. So we are assuming that this property within 5 years time, let's say if it appreciates by nothing or by 5% or by 7%, and how your return on investment and your equity and your cash flow, how those things are impacted by those things. So let's analyze what we did so far. So based on the 545,000 price, a $2,000 rents, the expenses that I put in there, this property is actually giving you a negative cash flow of minus 289. So a lot of investors, once they think of a negative cash flow, they don't want to invest. But what I want to emphasize over here is, for a property where there is a negative cash flow, we just want to go ahead and analyze what kind of returns it's generating. So if you look at it, this property at negative cash flow, its average annual return on investment at 0% appreciation is 3%, right? But that's totally unrealistic, because properties for the last 40 years, average annual appreciation is 5.5%. So a typical return would be in the next column. And to justify that, I don't have to justify much. The properties have gone from 20% to 40% in the last 1 year only. But again, this is not a market norm. Let's be quite conservative and go with the last 4 decades of average annual appreciation of 5% on a property. And so that column is the one that we will be looking at. So at 5% appreciation, your average annual return over a period of 5 years is 27%, which is a phenomenal number in terms of your average annual return. If you go further and talk about a 7% appreciation, your return would be 38%. There's some other really useful information. For example, your net equity or mortgage pay down plus growth. So it would spill out that how much of you own this property, or how much of the principal has been paid off, and your equity in the property. So in case of 5% appreciation, you have 311,000. In case of 7% appreciation, you have 380,000. That's both mortgage pay down as well as the growth in the property. So this was a quick analysis of this property based on the fact that it is a detached property and which is a single family home. And how this spreadsheet would help you and how the numbers would significantly change is, let us assume that this is a detached property with a legal apartment. So if there is a legal apartment in this property, your rent for the main level and for the legal basement would be, let's say you're charging, I don't know, 1900 for the main level and you're charging 800 for the apartment. So you change the rent to $2,700 and the whole picture changes here, right? So you get into a positive cash flow situation. That is why there is such a huge demand of legal apartments and duplexes. Challenge with the current market is right now duplexes anywhere in any suburb, almost anywhere is north of $1 million. So that is the scenario right now. However, there are still opportunities with unfinished basements. There are opportunities with legal apartments in detached homes where the price range is $600,000 to $700,000, right? So the reason I wanted to show this to you is how drastically the numbers would change. The numbers were extremely good when this property was a single family, one family occupying. You were getting a yearly return of 27% and in a 5-year horizon, right? Even at 0%, it was generating a positive return. But with this positive cash flow, your 5-year returns have now changed to 33%. And with 7%, it has changed to 44% annual return. So there's a drastic difference in that. That is just to sweeten it. Now, let's just do a little bit of a more analysis here. This analysis is based on a property that was bought a couple of years back. Let's go to today's world. And that's the power of a spreadsheet, that you can actually see things in front of your eyes rather than mental calculations. Let's say you buy this property for $700,000. So we change this to $700,000. We have 2.69% as the interest rate, and we change the interest rate to, right now the interest rates are really, really tempting. So let's say 1.7%. So, and based on this, you still generate a positive cash flow. You could still look at your 5-year appreciation, 0%, you have 8% return on this property. And on a typical scenario, you have 32% annual return on investment. Let's change the, what else we need to change here. Let me see over here. So let's go back to, again, the what if analysis that we could do is that this is not this is not a legal apartment, and there is a single family renting this, and the rent is $2,100, for example. You go into a negative cash flow situation, but your returns over here are still very appealing. At a 5% typical return, you are generating 28% return on investment. So this is a quick analysis of the benefit of investing in real estate properties, and the fact that the leverage is working for you. Your own investment in this $600,000 or $700,000 or $565,000 is 20%. The rest is borrowed money. So the returns are generated on the total amount. So that's the reason you see these magnified returns over here. So let's just do an analysis of a condo, and that would give you some sense of how, because you hear this a lot, that whether to invest in a condo, whether to invest in a detached property. So we would look into a scenario in the same spreadsheet where there is a condo. Okay, so let me open that file up. Okay, so now I'm not gonna pre-populate everything again. It's the same spreadsheet. I'm gonna make the size a little bit bigger, show you the same sections there. So this is a condo, a one-bed condo, and the price of this condo is $370,000. And again, these are real numbers of an actual property. The spreadsheet by itself generate the 80-20% down payment and borrowed funds analysis, the 2 months of reserve funds it keeps there. And let's just minimize this a little bit. And if you go down, you look at that the interest rate was the same, 2.69%, 30-year amortization terms. It generates the monthly payment for you. Go into the expenses section. So the annual taxes is $1,750. There is no property management on this. Utilities are paid by the tenant. Vacancy of 2%, I'm assuming. In Toronto, the vacancy rate is close to 1%. So that's a conservative number. This is what you need to look at over here, the condo fee. So this one has a condo fee of $321. Insurance is $112 because it's a condo, a lot less than a detached property. It gives you the monthly mortgage, and I'm assuming again there's $100 repairs or maintenance on monthly basis. So we're gonna analyze the same 5 columns. So at 0% appreciation, at a 5-year in a 5-year horizon, the property is generating a 2% return. Again, a more typical scenario of 5% appreciation, you're getting 26% return. Again, a lot of people, investors, they don't go for condos as investments, but if you are willing to pay from your pocket and you are generating 26% return on annual basis, this is again a really good investment. And keep in mind, a lot of buyers, first time buyers, a lot of investors, right now the property prices have just gone over the roof. So affordability for condos is there. That's why you see a lot of pre-construction projects going like hotcakes. Just last week, there was a project in Hamilton with 40 units. Guess how many offers for those 40 units? 4,000 offers for those 40 units in Hamilton. Condos ranging from $370,000 for one bedroom. So this is the type of supply crunch and demand in current market that we are facing. Just quickly look at a 7% appreciation. This condo is generating 37%. Again, I'll do the same analysis with this one, the one I did with detached. And I will make the numbers more attuned to today's market. So let's say you get a 1-bedroom condo now for $450,000. Okay, let's move the rent to today's rent of, let's say, $1,900. Let's change the interest rate, current interest rate of 1.7%. Okay, so just plugging in those numbers, the scenarios changed. You are having a negative cash flow of $95 in this situation. And that's a typical situation in downtown condo, for example. Now you would find a studio or a 1-bed in 450, 475 range. So these numbers are really current numbers. It's a resale condo I'm talking about. So as you can see, at 0% appreciation, you're getting a 7% return, which is an acceptable return at 0% appreciation. Talk about 5% appreciation, you're annual return on a 5-year basis is 31%, which is again a great number for anyone. So that in nutshell, this spreadsheet helps you as a tool. If you are investing, you plug in few numbers and you see and you play with those numbers, you change those numbers to see different prices, different ranges, different property taxes in different areas. And it's a lot better to do this than just to calculate numbers in your head and come up with an investment decision. So that's basically all that I wanted to present today. These two spreadsheets, they are very simple in terms of what we want to generate out of them. And as long as we are just touching the blue fields and plugging in these numbers, we generate other all types of analysis here. There's more to this spreadsheet. However, the scope is not like there is a cap rate which is more relevant for commercial properties, and then debt coverage ratios which banks look at. If you are an investor and you have multiple properties, they assess this number in terms of your viability of financing you for the second investment. But again, that would be going into a scope that I don't want to get into. That's pretty much all which I wanted to present today in terms of use of this tool for you guys. And now I'm going to open it up for any questions for 10 to 15 minutes. If any one of you want to talk to me or want to have a Zoom session to go into further details, you are more than welcome to do that. So you guys can unmute yourself and go if you have any questions.
Ali, this is Nadeem. Great presentation as always.
Thank you.
I have a couple of questions for you.
Sure.
First question is, does this tool apply to any Canadian property? Like, is it not specifically for Ontario? Am I right?
This is specifically for Ontario.
Okay.
This is specifically for Ontario. Uh, I mean, there would be differences. For example, Alberta does not have land transfer tax. You still can come up with a lot better number than just doing an analysis in your head. But this is designed for Ontario.
Okay. So you do need to know the property tax and the amount of the purchase price, right? Before you plug all these numbers in. As
Yes.
long as you have those two numbers, you are good to go. Am I right?
Yeah, property taxes, if it is an MLS listing, for example, it's specified there. Right, so that information can be found out. If it's a pre-construction, then sometimes the taxes are not determined as yet, but you still can have a general idea of the property taxes in the area.
Okay. My second question is, thank you very much. Is these days we have a perception that inflation factor is there, and as you know, oil prices went up, gold is down, and we're expecting inflation. Things are edging up slowly. So right now, interest rates are very, very low.
Right.
Uh, for sake of argument, if interest rate goes up next year or in 2023, um, how would you, or how does it impact on the returns, like you were showing us 27%, 7%, 32%? How would you relate this with the inflation factor?
Okay, really good question. So interest rates is a really interesting phenomena. Interest rate couple of years back was hovering at 4%, 3.9%, right? Right now, they are below 2% interest rates, right? So, first of all, it's not just that there is a possibility that interest rate would creep up. Interest rate has started to creep up, right? The more I'm talking to mortgage specialists and attending my company webinars, so interest rate has started to creep up. I just had a refinancing done where the numbers are not 1.6, 1.7, they're more than that, right? And probably you will see slow increase there. But interest rate right now is a rock bottom. So even at an interest rate of 3%, 4%, 5%, it's not gonna, I mean, and then again, we have a spreadsheet open in front of us. Let's move this interest rate to let's say 4.5%. And that's the beauty of a spreadsheet, right? Instead of me telling you, it would simply generate the you're getting a 21% return on 5-year basis at 4.5%, right? And my take on interest rate is based on a fact that when interest rate is increased, and again, it's my opinion, it's based on my research, it not only hurts consumers, it has a major impact on governments. So interest, and in my opinion, interest rates, the reason they go in slow increments, because there is a major impact on not just everybody, but government itself. So when the financing for government becomes really expensive, and it's not just an economy where people have a lot of debt, governments have debt in multiples of what people have, right? So in my opinion, it is in government's favor to keep interest rates on the lower side. Of course, they can fluctuate, but considering the scenario, possibility of interest rates dramatically rising, even for a longer span, is not looking probable. So that's just my opinion on this.
Great, thank you.
You're very welcome. Anyone else has
Me?
any question?
Yeah, this is Asim. Can you hear me?
Yes, Asim, I can hear you.
Yeah. So you mentioned this spreadsheet is for Ontario. Are you going to share this spreadsheet with the audience,
Yes,
or okay?
yes.
Thanks. I just
I'm
wanted
going
to put it
to.
for the the Calgary project that you shared with me, the new
So
condos and.
yeah, Asim, you could use this for that. The only difference is the land transfer tax is the only spreadsheet itself calculates the land transfer tax. Other
Mhm,
than that, it's the same analysis, right? You're looking at a 20% down payment. That was a pre-construction project, so I remember the down payment was less, right? So you could change these numbers over here from 80% to anything in blue is customizable. So you
mhm.
could customize this to come to get a lot better analysis even for that project.
Okay, great. Thank you. So you know what? I'll put the numbers in once I get this spreadsheet.
Yeah, and you could
Yeah.
feel free to call me, and I can look at it with you if you have any other question. A couple more things that I thought somebody might ask is, of course, there is no capital gain tax calculations that are inbuilt in this because it's based on everybody's individual situation. So that's on the negative side. On the positive side, for an investment property, your interest is tax deductible. So the effective interest rate is even lower than what you have as your actual interest rate. So that's also not built in. So, so the spreadsheet can capture analysis without these parameters. So that's all I'm trying to say. So with this, I really appreciate you guys, your valuable time on a Friday evening, this webinar. I will look into more topics in future, and based on your feedback, have come up with more webinars. In the meanwhile, if you have any question, feel free to email me, call me, or set up a meeting, Zoom meeting with me if you want to go through more in depth of these spreadsheets or to analyze a specific property. I'll be more than happy to do that. I will be sending the spreadsheets and these parameters that you need to plug in an email to all the participants. Thank you, and have a
Thank
great
you,
week.
Ali. I really appreciate your time, and this was very helpful. Thank you.
Thanks again, Asim. Take care. Bye bye. Thanks, Nadeem. Thanks, Cookie.
Sure, these
Bye
were so conducive. Thank you, everyone. Take care.